Good morning, everyone. So today I will be tackle about mergers and acquisition, investment banking, and portfolio management. Here are the learning objectives. So what is mergers and acquisition? A mergers occurs when two separate entities combine forces to create a new joint organization. Meanwhile, an acquisition it refers to the takeover of one entity by another. Mergers and acquisition may be completed to expand companies, reach or gain market shares in attempt to create a shareholder value. A two-term acquisitions and merger have become increasingly blended and used in conjunction with one another. We have a different types of mergers and acquisition. First is horizontal. Horizontal, it occurs when one company acquires another company in the same industry and works at the same production stage. The new entity may be well positioned because of its increased market share or scalability than the standalone companies combined to form it. I have here a real life example of horizontal. In 2019, Disney merged with 21st Century Fox went into effect. Both companies produce and provide entertainment and streaming services to consumers. Another example is the Northwest Airlines merged with Delta in 2008, combining their services into a single unit. So, in an horizontal, both the acquirer and the target firm tend to produce the same goods or services and at the same point in the production cycle. Vertical. Two or more companies that provide different supply chain function for a common good or service. Example of vertical. Merge between eBay and PayPal. So, we know that eBay provides a platform that allows people to sell items, while PayPal allows buyers to pay for these items. So this kind of merger can greatly increase efficiency. So in vertical merger, it reduces competition and can provide a new single entity with a large share of the market. Conglomerate is a merge between firms that are involved in totally unrelated business activities. So this merge typically occurred between firms within different industry or firm located in different geographical location. For example, the merge between Walt Disney Company and the American Broadcasting Company or ABC. So Walt Disney Company is an entertainment company, while American Broadcasting Company is a US commercial broadcast television network, the media or the news company. So the two firms will enter into a conglomerate merge to increase their market share, diversify their business, cross-sell their products, and to take advantage of these synergies. We have two types of conglomerate mergers, the pure conglomerate mergers and the mixed conglomerate mergers. So when we say pure conglomerate mergers, it involves firms with nothing in common, while mixed conglomerate merger, it involves firms that are looking for products extension or market extensions. Next, I will be tackle about strategic rationale behind M&A transactions. So we have efficiency. So efficiency, much like a person consolidating their debt, efficiency combinations have the effect of reducing a business operating cost, among other things. So efficiency, this kind of valuation creation of M&A can also increase the operational efficiency. So in either case, the anticipated end result is better scale with improved cash flow and profitability. Next is extension. The most popular reason for M&A transaction is to increase market power or share. So in extension, in this case, It combines a frequently pursued to expand a company's product lines or add a product category, or to widen their presence in a market they currently inhabit or enter an adjacent or new market. Transformational, so each lead to new capabilities that thus separate entities will never have on their own. Their topic is all about key steps involved in the M&A process. So first we have strategy development. So strategy development can help set clear expectation for all involved. While each deal is unique, so any strategy will address what your company hopes to achieve with the deals and how it will get there. Target identification. So legal team must search and evaluate potential target companies. So knowing who and what is involved and how the pieces are related and will help guide the due diligence process. Valuation analysis. To properly value and determine the suitable of the target company in line with the M&A strategic plan, a legal company needs to access to as much information as possible regarding the target operation, customers, financial, products, and more. Negotiation. So, once valuation model of the target company have been produced, your firm can present an offer and move on to the negotiation phase, where terms are discussed in more detail. So the next K is to conduct due diligence. So M&A due diligence requires a detailed examination and analysis of the target company from both internal and external sources. After the conduct due diligence is to deal closure. So the parties make the final decision on moving forward to execute this transaction. Financing and restructuring. So the final details typically come together once the purchase and sale agreement are complete. So after the financing and the structuring, so we have the integration and back office planning. So here, managing the integration of an acquired company is a full-time job and should be treated as much. So both parties should work together to ensure a seamless integration. So for legal teams, this means entity planning and compliance work in the localities involved. We have roles of investment banks in a capital market. Broadly speaking, investment bank assist in large, complicated financial transactions. So they provide advice on how much a company is worth and how best to structure a deal if the investment banker's client is considering an acquisition, merger, or sale. So investment bank employ people who will help corporation, government, and other group plan and manage large projects, saving their client time and money by identifying risk associated with the project before the client moves forward. Different financial products and services offered by investment banks. So we have underwriting. So here, bank raise capital for their clients from investors in the form of equity and debt securities. And advisory services are in the three phases: planning, timing, and demand and issue structure. Another is mergers and acquisition or M&A. So it is the consolidation of companies and assets through various financial transactions. So this include acquisition, consolidation, mergers, asset purchase, and management acquisition. Other is the sales and trading. So here, groups are the agents for clients, the sales trading group. So salespeople call institutional investor with opportunities. and trader execute orders and advise clients in case of enter and exit financial position. And we have equity research. So in equity research, the aim of equity banking is to offer clients recommendation on whether to buy, sell, or hold their investment. Next is the asset management. So it is involved investment in stocks, derivatives, fixed income stocks, and other investment. So there are various asset management products that are managed through separate accounts. Valuation technique used by the investment banks. We have price to earn ratio. So an acquiring company makes an offer that is multiple of the examining of the target company. So in examining the PE of all the stock within the same industry, next is the discounted cash flow. So analysis determine a company current value according to its estimated future cash flows. Next valuation technique is the replacement cost. So acquisition are based on the cost of replacing the target company. Next topic is all about the process of constructing and managing a diversified investment portfolio. So in step 1, determining your appropriate asset location is asserting your individual financial situation, and the goals is the first task in constructing a portfolio. So it is important items to consider are age and how much time you have to grow your investment, as well as the amount of capital to invest and future income needs. Step 2 is the achieving the portfolio. So once you determine the right asset allocation, so you need to divide your capital between the appropriate asset classes. On a basic level, this is not difficult. Equities are equities and bonds are bonds. Step 3 is your assessing portfolio weightings. So once you establish a portfolio, you need to analyze and rebalance it periodically because changes in price movement may cause your initial weightings to change. So to assess your portfolio actual asset allocation, quantitatively categorize the investment and determine the value's proportion to the whole. Next and the last step is to rebalance strategically. So once you have determined which securities you need to reduce and by how much, so you have to decide which underweighted securities you will buy with the proceeds from selling the overweighted securities. We have the different asset classes. We have fixed income or bonds. So you lend money to an entity and in return, they pay you a fixed amount until the maturity date. So which is the date when the money you initially invested is paid back to you. So the most common fixed income products are government and corporate. Next is equities or stocks. They are usually speaking about owning the shares in a company. So for companies to expand and meet their objectives, they often resort to selling slices of their ownership in exchange for cash to the general public. Buying these shares represent a great way to profit from the success of the company. We have two ways to make money from investing in companies. First is if the company pays a dividend. Next, if you sell the shares for more than you paid for them. Alternative asset classes, so such as real estate, the valuable inventory such as artwork, stamps, and other tradable collectibles. So some analysts also refer to an investment in hedge funds, venture capital, crowdsourcing, or cryptocurrencies as example of alternative investment. Investment vehicles. So we have exchange traded funds or ETF are versatile investment tools that offer broad market exposure at relatively low cost. So they comprise a collection of securities such as bonds, commodities, stocks, currencies, derivative products, and more recently, Bitcoin futures. Mutual funds invest in a diverse portfolio of stocks, bonds, and other securities using the fund collected from small group or individual investors. So the SEC offers detailed information on mutual funds, including important points on investor protection. That's all of my report. Thank you.